Hello and welcome to today's Investment Foundation Certificate live learning webinar. I'm delighted to introduce Tom. Tom is our instructor for today, and Tom is a CFA charter holder. He is a director for exam development at CFA Institute.
First of all, welcome to this session. It's a huge honor to be able to teach you guys for this session. Just by way of introduction, very quickly, of course, this is some content that's kind of selected from the Investment Foundation Certificate here at the CF Institute, and this kind of giving you an opportunity to I guess, get an indication of the sorts of material that would be covered in that particular syllabus. Ideally, you can kind of see it as a kind of a precursor to some of the content that you will find in the CFA program. Just a little bit of the flavor of what we're going to cover there. Just get rid of that poll. Keeping it pretty simple. The idea of a long position and a short position. To develop that. And so, well, actually, if we take a long position, I want to try and just stretch this a little bit and say, well, we could go through an example to kind of represent the concept of leverage. It really gives you maybe some simple numbers just to kind of show you how it can enhance your kind of gains, but at the same time also has the potential to kind of enhance your kind of potential losses. And then what I'm also do towards the end is just kind of anticipate this kind of concept that we can have what we call quote driven, order driven markets. We can maybe have this kind of order driven system. People put in orders to buy and sell. The idea there are different types of orders you can place. And what I want to try and do as well is go for an example of a limit order, just to kind of show you the kind of process of how you can kind of really appreciate that kind of share prices can kind of move by, of course, by the activity of kind of buying and selling. So we'll start. This is from the ground up. I fully appreciate that. You might come into this having done the CFA chart, and you think, wow, what's all this? Remember, the Investment Foundations is geared towards helping people understand some sort of basic financial terms, position yourself into the world of finance, different departments, different asset classes. It does really give you a nice kind of good foundation to the kind of world of finance. So first of all, this idea of taking a position, you have a view, you work for a bank, you're in research, you're a trader, you've got this idea that there's a particular stock that you like the look of, that you can kind of take a position to anticipate that you believe there could be a change in share price of the stock that you're looking at. And like I said before, the kind of classic that people will often kind of attach and probably be most, I guess, reasonably aware of is the concept of taking a long position. The idea of long is saying that you buy, right? I want to buy a security. So I pick a particular stock that I think will increase in share price in the future. So I buy that stock. Now, what you hope for is you want to buy that stock at what you perceive to be a low price. You take what we call a long position. Essentially, you end up owning the security. Time passes. Every single trade I've ever engaged in has been a profitable trade. Obviously, it hasn't, but let's assume it has. And I hope that the share price goes up. So simple numbers. I bought at a price of 10. The share price went up. Let's say it goes to 12. And then what I'm going to do is I'm going to close out my position. So you can open a position by buying the share, going long, and then I can close my position by then deciding that I wish to sell that share. And in this case, I bought low and I sold it high. Okay. And no tricks here. The difference, the fact that I paid 10, sold it for 12, I've made a gain of 2. So that is kind of the classic long position, but also, there will be occasions where we have bad news, and bad news has an effect where it causes share prices to fall. So again, people can take maybe some sort of, I guess, profit from that anticipated decrease in share price, where what they could do is actually open a short position in anticipation of share price falling, and then finding that what they're going to do is what we call close out their position by reversing the trade and then buying back the stock in this case. So this, for some people, is a little bit harder to kind of get their heads around. But to take this kind of short position, and we're going to say, well, we're going to initially sell the stock and sell the stock at what we perceive to be a relatively high price. I mean, we think the share price is too high. And I'll keep a simple example here. let's say that's equal to 10. And then if I'm correct, because like I said, every single trade I've ever done has been profitable. But in that case, I sell it high. The share price falls because everyone believes Tom in the fact that he felt that this stock was overvalued. The share price reduces, let's say, to 8. I then close out my position by deciding to buy back that stock. So basically, you sold it high, and then what you're going to do is buy it back at a lower price. Now, that's simply explaining the concept of being long and being short. Now, you might turn around to me and say, well, yeah, kind of point two there. I kind of get that. Yeah, short position. You're going to sell the stock high. And then you kind of say, well, you know, being realistic, Tom, I don't actually see the share in your hand. So how can you sell the share if you don't physically own that share? What we're going to just show you, and again on the next slide here, just kind of give you the kind of mechanics to a certain extent of how, let's say, short positions may actually take place in the market is that, not great at drawing, but for example, if I put in there in the middle, that's me, that's Tom. Like I said, just to use a bit of jargon, I decide that I'm going to be taking a position of going short. So I want to open my position. And let's say the investor wants to sell the security in the market. In my example, what was it? I wanted to open a position when the share price was 10, anticipating the share price was going to go down to 8. So in that situation, at the end of the day, I can't, go short in the stock unless I don't have the share in the first place. So what we're just going to maybe appreciate on the left-hand side is that actually I'm the investor, don't borrow the security from someone in the financial markets who's willing to lend it out. So the idea is that the financial markets will act to kind of facilitate lots of activities within the world of finance. And one of them could be that you have, for example, I'm using a jargon here, but what we call stock borrowing and lending intermediaries, where they have the ability to go and source, let's say, securities for people that want to short sell. So you may find on the left-hand side, just as a particular example, there may be what we call long-only investors. So it could be so what we call sometimes institutional clients, maybe a pension fund. And the pension fund has stock lying around that is willing for a period of time to lend out that stock, lend it out to Tom who wants to short sell that stock, and that helps to facilitate the short transaction. You might say, well, why would the pension fund be willing to lend out its stock to Tom? Well, the world of finance involves, of course, money and fees. Of course, the pension fund could receive or will receive a fee for lending out the stock for the period of time that I've decided to go and short sell. Things to bear in mind as well is that Tom as well in the middle, would be required to help compensate the investor for the fact that they've lent out the stock for a period of time, or that they would have received dividends over that period of time. So you'll often find that there could also be other arrangements in place, and that could be to facilitate some sort of what we call manufactured dividend back to the investor who has lent out their stock. But of course, like we said before, after a period of time has elapsed, we'll then find that I decide to close out my position, and that would be to take the opposite position where I had sold short. I will then go long, buy back the stock, and then that would close out my position. That's the word we would use. You've gone short and then long, almost negates it, and then I profit on the difference, which is 2 in that case. Now, the other bit that we also have in the kind of context of the world of finance, I'm not going to run through this kind of concept of what we call leveraged positions. I'm going to try and show you, we'll zoom in on that later on, so don't worry too much, but try and show you this idea that the concept of leverage will allow investors to enhance gains and enhance losses. Same with the short position, taking that position of short, when we tend to associate the fact that people buy shares and hold. Now, what I'm going to do is going to put the strap to one side for the moment. It's got a concept of a leverage position, bit of a diagram, bit of an example, right? So let's say that we wanted to buy a property, right? That's the asset, right? So there you go. There's the property, and the property has a price tag of 100. All right, and then that could be in the UK, it could be £100,000, $100,000. Yeah, how much a house costs. I turn around and say, look, I'd love to buy my house, but the problem is they don't have enough money, right? So I go to a bank. Bank says to me, yeah, Tom, okay, fine. What we would like you to do is you can put down, right, what we call a deposit. Okay, and keep it simple. Let's say they say that we want you to put down a 10% deposit. All right. So I put down 10% of the 100, which is 10. And the bank says to you, look, we're very nice, right? You've been a good customer, right? In which case we'll lend you the difference, which is 90. And in the case you've now managed to buy the asset, which is worth 100, right? So in this case, very simple, right? Okay. So the amount borrowed, look in the box there. I'll highlight that in blue. In this case, that's 90. Right, the value of the asset that I've just bought, right, there you go, is 100, right? So think of that as the value of the property. Right, in this case, we're going to relate this to stock price, so share. And then what I've done is I've therefore, on the difference, put down a deposit of 10. Right, now that deposit in the world of finance is often referred to as your equity position, right? And that's usually specified by exchanges. If I go to an exchange and I can buy on leverage, right, they'll often specify what we call an initial margin. The initial margin kind of represents what you put down as the equity or the deposit for the transaction that you've engaged in, right? So the effective leveraging position is to exaggerate gains and exaggerate losses. Now, hopefully you can kind of see this, but just a very simple numbers game, right? With the house in this case, house increases in value by 1. Okay. Now that 1 is increased on top of course, the asset which was worth 100 at the start. So no rocket science here. That represents a 1% increase in the value of the asset. Okay. So the asset has gone up by 1. It was worth 100 in the first place. Right. Now that asset, great, has gone up by 1%. But then if this is me again, I bought the property by paying a deposit of 10, you're thinking, well, actually, for me to have the economic exposure of the house price going up by 1, all I've had to do is put down my deposit of 10, yet I still get to capture the 1 increase in the value of the asset. And if you look at it in terms of your return as a proportion of what you put down, I put down 10, which is the deposit, yet I get kind of capture, if you like, that +1 on the value of the asset. And of course, no trick, right? You've managed to generate actually a percentage return of 10%, yet the asset has only gone up by 1% in value. So you've got enhanced gains by the fact that you put down only a deposit. So this idea, which introduced this idea that there is leverage in the world of finance. And really the only thing that I need to do is say, well, if you can do it with property, then we can just change the kind of property as the asset and say, well, that could be a share. And again, you've got an example here. Look, right? An investor buys a stock at 50, borrowed 40% of the purchase price. So the amount borrowed we've got here would be 40% of 50. And then that was the share price. 40% of that amount, which is 20, is the amount you borrow. The investor's equity would therefore represent the difference. If the asset, like we just said there, was 50, 20 was borrowed, and the difference, as you said before, is your equity. This is the deposit that you're putting down to invest in this particular stock. And I know the diagram on the right-hand side is quite small, so I might just try and zoom in on that just a little bit, just hopefully you can just see it a little bit better. But again, we just kind of reiterate that point. You know, the idea that we can see that there is an enhanced effect of 1 point, was it 7 times higher than the change in the value of the asset. So on this diagram, what that's trying to show you, if I just again zoom in a tiny bit more, a bit too much, then we had for the increase in the share price by 5, the dotted line kind of represents what the change in the value of the asset was, which is 10%. But actually, from the investor's perspective, that's the blue line there, that translated to 16.67%. So what we're trying to show you with this diagram is the fact that for a change in the value of the asset going up, the share price rising, then with leverage, a kind of solid line shows you that my returns are enhanced with leverage. But of course, the risk is you get it wrong and end up sort of, generating significant losses at the same time.